Okay, so hello everyone, and welcome to day two of this webinar arranged by ACCA specifically for the students sitting in September exams. So in the last session, which was conducted yesterday, we started our portion of investment appraisal. And in the portion of investment appraisal, we discussed a very detailed question regarding the overseas appraisal. Okay, you were told that when we plan for investment appraisal, when we plan for investment appraisal, basically the thing is that we have to see two things. One is called domestic appraisal, and one is called foreign or overseas appraisal. I told you about the quotes, the currency conversion issue, which will be heavily tested in today's session. And then I told you that when you are in one country and you're investing, for example, in UK, all inflows outflows have to be in UK pounds. Okay. There was a concern among students who were specifically sitting AFM exam in locations where the remote exams are being conducted. They have to answer on CBE platform. So I told you I solved the question on the CBE platform as well. Hopefully, I received many comments after the class specifically from those students who were having panic attacks because of the CB thing, that it's easy. And I already told you before starting yesterday's session that it's going to be a piece of cake for all of you. Okay, after the lectures are over. Okay, so in the last question, I just have to wind up the last question because we have to move to other areas quickly as well, because we are trying to cover multiple portions in this webinar as well, all the important portions. Okay, so basically you were told in yesterday's session about a company which was Yalandwe. Okay, and Yalandwe country was struggling somewhat financially, so fiscal rate, taxation rate, everything issue. They offered two concessions: zero tax and opportunity to carry forward tax losses. Okay, and then after that we were told about Imani company, that Imani company was based in USA and it was planning to invest in an assembly plant in Yalandwe where the financial projections and everything was given. Okay, now after that all the financial projections, you were firstly told to state the benefits and drawbacks of setting up own plant. So if you do FDI, if you set up your own plant, what are the benefits and what are the drawbacks? That needs to be addressed, that needs to be considered. Okay, so when we plan about setting up own plant compared to licensing, obviously it has some benefits: motivation among employees, and technological secrets remain with the company, but it has drawbacks as well. And then we were asked to evaluate the financial acceptability, so we found NPV. And since we were in USA and investing in a plant in Yalandwe, so all inflows outflows have to be in Yalandwe rands. Where that is not the case, we converted. So we wrote investment, we wrote revenue, we wrote variable cost, we wrote fixed cost. You need to record inflows as inflows, outflows as outflows. Then the Imani company was asking for royalty, so royalties is a cost for them. Okay, then special equipment for packaging, that should also be done. So taxable profits. Okay, on these taxable profits, we deducted tax allowable depreciation, loss carried forward, then we paid tax on it at 40% after tax. We used to add back depreciation, add back loss carried forward, and after that we did working capital and we got net cash flows, obviously in rands. Okay, now this is a scenario with overseas appraisal, that when you got net cash flows in Yalandwe rand, you won't let that cash remain there because Imani was in USA. All that cash would be remitted to your home country, called net cash flows in dollar or remitted cash flows. Okay, so you applied an exchange rate, but at the time of exchange rate, I told you multiple times that remember this thing carefully. When you're investing in a project, you wouldn't use Rand. If Rand was a numerator, it was a direct quote, you needed to multiply. But when you are remitting, you are now in your home country, USA. The dollar rate was in denominator, it was an indirect quote, we divided. Okay, we got net cash flows. Now, usually these net cash flows have to be multiplied with discount factor to get present value and NPV, but it's just a guidance to you. You have to complete the question yourself. Many students have already completed, as I told them, but they just told me that in the starting 10-15 minutes, if I can just give an idea about the remaining aspects, and then you can complete it yourself, because I provided you solutions as well, and you have to move forward towards the next topic as well. Now, once you get net cash flows in dollars, you brought money in your home country. Any additional inflows or outflows in US dollars, that also needs to be considered. Like, for example, I am based in Pakistan and I invest in a project in UK. All inflows, outflows were in UK pounds. Okay, but when I remit amount back to Pakistan, my home country, if there are any other inflows and outflows in Pakistan, I have to bear that. Similarly, iMoney was in USA and it wanted to invest in an assembly plant in Gillandway, so all inflows, outflows were in Gillandway rands. But when it remitted amount back to USA, if there are any other inflows, outflows in dollars, that needs to be considered. Now, you need to remember that there is likelihood of usually these four items. One is called additional tax. Okay, one is called after tax royalty income. Okay, one is called after tax contribution. Okay, and one is called redundancy and lost contribution. So you can memorize this, that usually when you do overseas appraisal, once you remit the amount back, if there are any additional inflows and outflows in your home country, you need to consider them, like additional tax, after tax royalty income, after tax contribution, and redundancy and lost contribution. Now, what is this all about? What is this additional tax? Now, sometimes, as you look at the question, I was in USA and I invested in an assembly plant in Gillandway. So investments, everything was in Gillandway, and I paid tax in Gillandway. When I brought money back to US, the US authorities may ask for more tax because you have brought money in your country. Why didn't we take this tax? Because there was a bilateral treaty. You have already paid tax in Gillandway. When you bring money back to USA, since there is a bilateral treaty, you don't have to pay double tax. But I just want you to make sure that you memorize this thing, that additional tax can be an issue, that if there is no treaty, then you have already paid 40% there. And when you bring money to US, you also have to pay tax here. Okay, then after tax royalty income, remember, iMoney was asking royalty from the assembly plant. iMoney was asking royalty from the assembly plant. Since iMoney was asking royalty from the plant, so it was a cost for the plant. Yes, we deducted that as an outflow. It was a cost for the plant, but it's an income for iMoney. It's a cost for the plant, so we charged it to the plant, but it's an income for iMoney. So you recorded a cost here for the plant, but you need to record income in dollars for your land. So many people say that when we have to record a cost here and income for this, better ignore it. You are recording costs one way and then income other way. So no need to record it. No, you must record it. The first basic reason, that carries must, and the second reason, for the plant, it's a cost and the cost will be in rands, remember. But for the iMoney company, when they remit money back, it's an income for them. And income is in dollars. So due to currency fluctuations, the figures won't just offset. They will create a benefit or loss. So always remember, when the parent company asks royalty from the plant, it's a cost for the plant, but income for the parent. Okay. Similarly, remember, The iMoney company sent special parts from USA to the plant at a cost of $280 per unit, on which they earned contribution. So it's a cost for the plant. So we recorded a cost for the plant. But since iMoney is sending plant the parts at $280 per unit, on which they earn contribution, so it's a contribution income for the plant. You need to record this contribution. And lastly, it was written, if iMoney decides to invest in the assembly plant, its exports would fall and would incur redundancy and loss contribution. So redundancy and loss contribution is a cost. Loss contribution, redundancy, it's a cost. You need to record the cost for iMoney as well. Once these four things are adjusted, you get net cash flows, and from that net cash flows, you need to multiply it with discount factor, which was 12% for this project. You get present value, and the net of all is NPV, which if positive, you need to accept. If negative, you need to reject. Okay. So always remember, we have studied this in detail, that once you remit amount, we discussed in detail yesterday, you have to consider four more inflows, outflows, which have to be borne by the parent once they remit money to US. Additional tax, if there is no treaty, you have to pay tax here as well, what's an outflow. If you ask royalty from the plant, it's a cost for the plant, but income for you. If you are sending parts from them for the plant and you earn a contribution on that, it's a cost for the plant, but income for you. And redundancy, loss contribution, deal these four things to get net cash flows, discount factor, present value, and okay. So you can cover this stuff from the answer and notes provided to you. And if you have any questions, you can ask me on the WhatsApp group as well, because we created the group last night, and there were hundreds of questions, and I tried my best to answer as many questions as possible. Sooner or later, I will answer all questions. So many students, they were stuck in some questions. Obviously, it is not possible for us to deal every individual question of P4 in this webinar, because it's just for key issues. However, the main reason for the group is that students are taking screenshot of the questions, sending me their problematic area, and I'm replying them. Okay, so if you have any questions other than this, you can always refer. Okay, and we will be moving forward towards the next issue. Our today's agenda is to deal currency risk management. Just 2 minutes. If you have any questions with respect to these four things, you can ask, and then we will move. Okay. So those of you, there are many questions, who have missed the first webinar, they should contact the ACCA and they will upload it. And I think there were some students who also shared the link of YMU on the WhatsApp group. Okay. There's one student saying, I'm not audible. I am audible. It's a problem from your side. Recordings are usually uploaded the next day, and I think Osman, as far as contribution of 120 is concerned, if you read the statement, the special packaging material will be sent by iMoney at a cost of $200, on which they earn contribution of 40. So when you are sending goods worth 200, the contribution is 40, but you are increasing the transfer price to 280. So if you increase the price by 80, obviously the contribution won't remain 40, it will also increase by 80. So it will become 120. The examiner answers didn't deduct lost contribution because they stated the reason in the end that it's immaterial. However, if you deduct that, you won't lose marks. Yes, I'm sharing my number as well, and I'm sharing the WhatsApp group link as well. Avalon loss carried forward, non-cash transaction, it needs to be added back because it's just dealt for tax purpose. It's a non-cash item. No, man, you can refer that. It's not the case. Nakishia, maybe you joined late. I will ask some students. And here, there's a student, Varsha. She has been very helpful and she has given us the link of last class. So I will share it with all of you. Yes, Janko Bass, you are absolutely correct. Amsal, always the negotiated one. Okay, so firstly, when we talk about this group link, so firstly, I have sent the last class video link. Okay. Second thing, this is my WhatsApp number. So you can WhatsApp me if you are having problems in joining the group. And let me do the third thing for all of you, the WhatsApp group link. Just wait a second, please. Okay, so let's start the risk management, currency risk management. This is our today's agenda, that we need to study currency risk management. Okay, now as you all know that risk management involves two broad areas. Number one is called currency risk management. Number two, interest rates. Okay, so this is a very important portion of AFM exams, and I think if you have the proper skills with you, this area is likely to generate 25 marks minimum for you. Either currency risk could be tested or interest rate risk will be tested, or both will be tested in a combined question. So in today's agenda, we will be dealing with currency risk and then we will deal with interest rate risk. Okay, so let's start with currency risk management. Now, before I start currency risk management, I basically want every one of you to get an idea of what currency risk exactly is. Okay. So what exactly currency risk is? We will deal currency risk management shortly. But firstly, before starting currency risk management, what exactly currency risk is? We basically define currency risk as the risk that currency rates go up when you have to pay someone, or risk that currency rates go down when you have to receive. This is exactly what currency risk is. I'm not talking about currency risk management. I'm just talking about what exactly currency risk is. Currency risk is the risk that currency rates go up if you have to pay, or currency rates go down if you have to receive. Like, for example, I'm in Pakistan. I have to pay someone $1,000 after a week. I'm in Pakistan. I have to pay someone $1,000 after a week. There's always a risk that when I go to pay after a week, the rates may go up from today's rate. Okay. For example, I'm in Pakistan. I have to receive £1,000 from someone next month. £1,000 from someone next month. There's always a risk that when I receive that money, the rates go down. Okay. Many students may have faced this risk when they want to submit their ACCA annual subscription fees or examination fees. Like, for example, a person may have plans that he will pay 100 GBP, the examination fees approximately next month. There's always a risk that when the payment date comes, the pound rates, the GBP rate goes up. Okay. Similarly, some of your friend or relatives sent you some money. Let's suppose 1,000 AED dirhams or 500 euros. And when you went to convert them, there is always a risk that rates go down. So everybody faces currency risk in his life. It's basically the risk that currency rates go up when you have to pay, or currency rates go down when you have to receive. Okay. Obviously, this happens because currency rates keep on moving constantly. This happens because currency rates are not stable, they change. Okay, so there is absolutely no chance to prevent this risk. There is absolutely no chance that one can prevent this risk. However, this risk can be minimized or managed through some hedging techniques. Okay, one cannot prevent currency risk. It's a reality. It can only be minimized or managed. There are multiple requests to send the WhatsApp group link immediately. So I'm just fulfilling that request. I don't know why some people can't wait. Okay, so I fulfilled the biggest request of WhatsApp group. So anyways, back to the topic. So I was talking that before starting currency risk management, I'm talking about what exactly currency risk is. So currency risk is the risk that when you have to pay someone, the rates go up. When you have to receive from someone, the rates go down. This happens because currency rates keep on fluctuating. There is absolutely no chance that currency rates stop moving. They keep on fluctuating. So this risk can be prevented. It can only be minimized or managed, and they can be minimized or managed through some hedging techniques. Now, there are multiple hedging techniques in practical. However, we will be focusing on three most commonly used hedging techniques. One is called forward exchange contracts. One is called currency futures, and one is called currency options. Okay, there are many more techniques like leading, or like money market hedging, or like netting. But if you have any idea about P4 past exam papers, these three are the most commonly tested techniques: the forward exchange contracts, the futures, the options. That's why I will be focusing on these three techniques in the webinar: forward exchange contract, futures, and options. Okay, so basically, since currency rates keep on moving, and importers and exporters are always worried about this, that whenever we plan to pay someone in the future, there is a risk that rates go up. Whenever we plan to receive money from someone, there is a risk that rates go down. So always they face this risk that is called currency risk. This risk can be prevented. If someone says that I can eliminate this risk, he's misleading you. It can only be minimized or managed through use of some hedging techniques. That is called risk minimization techniques. So we will be focusing on three most commonly used techniques here: the forward exchange contracts, the futures, the options. Now the first technique, forward exchange contracts. Okay, forward exchange contracts is basically a risk management technique in which we basically fix a rate for any future transaction. Forward exchange contracts is basically an arrangement offered by banks or different money changers or financial institutions where we fix a rate for any future transaction. Okay, let's suppose I have to pay $1,000 in a month. Is there any risk? Yes, there is a risk that rates may go up. You can do this forward exchange contract. You can fix a rate. If the rate is fixed, no matter what the rates go up, down, you won't have any impact. Okay. Similarly, you will be receiving $500 in 2 months. Are you facing any risk? Yes, the rates may go down. So what you can do is you can do forward exchange contract. It fixes a rate for any future transaction. If you fix a rate, any changes won't impact you. Like you have to pay a huge amount to ACCA in examination fees, and you are afraid that the rates may go up, the GBP rates may go up. You can offer forward exchange contract, fixed rate with any money changer or the bank or any financial institution, which prevents you from this. Okay. The approach of forward exchange contract is you simply have to divide or multiply the amount by the relevant fixed rate. It's just a one-step approach of forward exchange contract. That's why it carries hardly 1 or 2 marks. You need to divide or multiply by the transaction amount. Obviously, divide if it's indirect quote. I told you we divide if it's direct quote, we multiply it. We have seen this yesterday as well. You just need to divide or multiply the amount by the relevant fixed rate. Whatever the rate is being fixed. Let's suppose GBP is fixed at 2.2 or 2.5. You just have to divide or multiply the amount by the relevant fixed rate. I will explain it in detail when I'm doing a question, but I just wanted to tell you two things. Forward exchange contract is just a rate fixation arrangement. We fix a rate for any future transaction. The approach is you just need to divide or multiply the amount by the relevant fixed rate, the rate which you have fixed. Okay. Division if it's indirect quote, multiplication if it's direct quote. Currency futures. Okay, what are currency futures? They are also rate fixation contracts. In these contracts, we also fix rates. But The difference is that they are standardized. What is the meaning of standardized? Forward exchange contract, rate fixation contract can be done for any amount. $120,000, $98,000, euro 560,000. Forward exchange contract transaction can be done for any amount. But in futures contracts, we fix rates for standardized amounts. Standardized means the money changer at the bank states that either it's going to be for 100,000 USD or 200,000 or 300,000, or it's going to be $100 or 200 or 300. Your own wished amount cannot be taking place in futures. It's only available for forward exchange contract. Futures is standardized contracts. Okay. Approach. Now my approaches are quite easy, and if you haven't studied from me before, you will really be feeling after the class that you have a complete grip on futures, options, and forward exchange contract. The approach is 3 steps. Find lock-in rate. Okay. Find expected receipts or payments using lock-in rate. Okay. Find expected receipts or payments. I don't know the question can be of receipts, the question can be of payments. So find expected receipts or payments using lock-in rate. And step 3, find number of contracts. These 3 steps carry marks in the marking scheme, that you need to find the lock-in rate, then you need to find expected receipts or payments using this lock-in rate, and then you need to find number of contracts. Okay, I will just explain you what lock-in rate is. Then we can take questions from you. Lock-in rate is just like an average rate. Lock-in rate is just like an average rate. Like for example, you have to pay after 3 months. Lock-in rate is just like an average rate. For example, you have to pay after 3 months. And when you go to the person or institution who's offering you contract, you see that the 2-month rates are 5.5. Okay, and the 6-month rates are 5.9. You want to pay after 3 months, but when you go to the offerer, he's offering you 2-month rate 5.5, 6-month rate 5.9. So here you need a 3-month rate, that is called lock-in rate, average rate. You just see the trend. 2-month rate was 5.5, 6-month rate was 5.9. The trend was rising by 0.4 in 4 months. The trend was rising by 0.4 in 4 months. Okay, so if the trend was rising by 0.4 in 4 months, so it's gonna be 0.1 per month. If it's 0.4 in 4 months, so it's rising by 0.1 per month. Now you can get the 3-month rate. See, the 2-month rate is 5.5 and it's rising by 0.1 per month, so you need to add it. The 3-month rate is 5.6. This is called lock-in rate. Repeat, you want to pay after 3 months, so you need a 3-month rate. When you go to the offer of the contract, he's saying 2 months rate of 5.5, 6 months rate of 5.9. We need a 3-month rate. You just need to apply averaging strategy, that the 2-month rate is 5.5, 6-month rate 5.9. It's increasing by 0.4. In how many months? 4 months. So per month it's 0.4 over 4, 0.1 per month rising trend. So took the 2-month rate, you went for a 3-month rate, increasing by 0.1 per month, added 5.6 is a 3-month rate. One more example. Let's suppose you have to pay or receive after 5 months. You have to pay or receive after 5 months. So when you go to the offer, he's saying three-month rate 2 and 7-month rate 1.2. It's irrelevant for you. You need a 5-month rate, 3-month rate is 2, and 7-month rate is 1.2. See the trend, apply averaging. It's falling by 0.8 in how many months? 4 months. So if you check per month, it's 0.8 divided by 4 months. So falling by 0.2 per month. Okay. So if it's falling by 0.2 per month, what you can do is you have the 5-month rate. 5-month rate is, sorry, 3-month rate. It's 2. So it's falling by 0.2 per month. So in 4th month, it will fall by 0.2. And in 5th month would fall by 0.2 more, or you can deduct 0.2 into 2. It's gonna be 1.6. This is called lock-in rate or averaging rate. Okay, so in the first step, you need to find lock-in rate, then receipts payment using lock-in rate, and then number of contracts. I hope you got the idea of lock-in rate. It's just the averaging rate, whatever the trend is there, rising or falling, make it per month, and then either increase it or decrease it. Okay, now you can copy this also, and if you have any questions, you can ask. Sufyan Nizami, there are several rates given. It's very confusing how to select a rate. That's what the art is. If any tutor teaches you this art, how to select the appropriate rate, that's the thing. So this thing will be covered in options because multiple rates are given in options. And I challenge you, you will absolutely be comfortable with options after my lecture. Sahan, there is absolutely a nominal difference in OTC, over the counter products, and exchange traded products. You see, if you focus on the name, exchange traded means they are traded on an exchange. Like for example, any product on stock exchange is called exchange traded product because there is an exchange. Similarly, there is in our country, Pakistan, mercantile exchange through which we trade the commodities, gold, silver, crude oil, etc. It's an exchange. A regulatory body is set up and you need to enter into contracts through that body. That is called exchange traded. Okay, but over the counter, there is no exchange. The parties deal directly. There is no regulatory body. The parties deal directly. So Vedula, there are two examples on your screen. In one, the prices are rising, and in one, the prices are falling. If the prices are rising trend, you need to add that. But if the prices are falling, you need to deduct. Varsha, for that, you have to contact me on WhatsApp. Hamza, if you have missed the last class, it's better you don't ask it in risk management. You can ask me on the WhatsApp group. So Nahida Noori, why are you just deducting 0.2 one time? because your 3-month rate is 2 and you have to go to 5-month rate, 2 more months. So in 2 more months, it's falling by 0.2 in each month. So if you will just deduct 0.2 one time, it will go to 4th month. And once you have to deduct 0.2 more, then it will end up in 5th month. Standardized means it's not available for the amount you want. Like if you want to minimize risk for $550, you can offer forward exchange contract. If you want to hedge risk for $710, you can opt out. But in futures, it's a standardized contract. The money changer or the financial institution will say that we only offer for $100, $200, $300, not yours. Rakib Zaman, you have mentioned the same question 5, 6, 7 times. So obviously I have to look at many questions. Please ensure the question is coming just one time. I will shortly answer your question, Rakib. Yes, Minal, you are right. Now, when you talk about this lock-in rate, so there are 2 approaches of dealing with lock-in rate. One is the basis approach, which is the rate difference, and one is the averaging approach. So if anyone is comfortable with basis approach, I would advise them to continue that approach. I want to make things very easy here. That's why I am not applying the basis approach. I am using the lock-in rate averaging approach. So if you want to follow this, then it's fine. Else, if you are comfortable with your taught basis approach, you can use that. Okay, both are acceptable in the exam. Salima, you have to wait for this. You will just be seeing this. Okay, so now we will take questions later and let's continue. So we can't eliminate currency risk. We can only minimize it. So how to minimize or deal with currency risk? There are some risk management techniques, the hedging techniques, forwards, futures, and options. I told you what forward exchange contract is. It's just a rate fixation contract. And the approach of dealing with forward exchange contract is the very simple one. A simple approach of dealing forward exchange contract is you just have to apply, divide or multiply the transaction amount with the relevant fixed rate. Okay, so it's very low mark question, the forward exchange contract question. So then the next thing is currency futures. In currency futures, there is also a rate fixation contract, but with standardized amounts. You can't get a hedge for your own wished amount. It's standardized. It's a 3-step approach: lock-in rate, the main step, expected receipts payments using that lock-in rate, and number of contracts. The concept of lock-in rate is done through 2 things: the basis approach, the averaging approach. Averaging approach is easy, that's why I follow that approach. Okay. Now, what is this lock-in rate? It's just an average rate. Let's suppose you have to pay or receive after 4 months. Let's suppose you have to pay or receive after 4 months. Okay. When you go to the offer, he is offering 4-month rate, 6-month rate. No problem. You want to receive after 4 months, the 4-month rate is given, transaction closed. Okay. But let's suppose you will be receiving after 4 months. And when you go to the offer of the contract, he says 2-month rate, 5-month rate, 1.1, 1.4. Okay. So you have to get a 4-month rate. It's not given. Apply averaging strategy. 0.3 rising in 3 months. So it's going to be 0.3 over 3 months, 0.1 per month. Okay. So it's rising by 0.1 per month. You are given with 2-month rate. It's 1.1. Okay. You need a 4-month rate. So you need to move 2 months more. It's rising by 0.1 each month. So add 0.1 one time, so it moves to 3 months, and then 0.1 one more time, so it moves to 4 months, 1.3. This is called the 4-month lock-in rate. Okay. Similarly, you will be receiving or paying after 7 months. Okay. When you go to the offer, he says 6-month rate 5 and 8-month rate 4.5. So obviously I want to receive after 7 months. I need a 7-month rate. The rates are 6 months and 8 months. So I need a 7-month averaging rate. It's falling by 0.5 in 2 months. Okay, so per month. Okay, so take the 6-month rate. It's 5. You want to go to one more month, the 7-month, it's declining by 0.25. So deducted 0.25, 4.575, sorry. This is the lock-in rate. You need to find expected receipts payments using this lock-in rate and the number of contracts. One student was asking, sometimes there are 2 lock-in rates given. How do we decide which rate we have to use to do the average? Now, 2 rates are usually given in futures, in forward exchange contract, everywhere 2 rates are given. That's normal. If 1 rate is given, you are lucky. Usually 2 rates are given. So you need to remember a principle which is quite logical. When you are paying someone, when you have to pay $1,000, you need to buy currency from the money changer. So you always use buy rate in payments and apply the averaging, etc., whatever we have to do. But when you are receiving $1,000 from someone, when you receive $1,000, you go to money changer and sell it. So you always use the sell rate in receipts. People say this is something like rote learning, that in payment you use buying rate, in receipts use selling rate. No, it's not rote learning, it's logic. That when you have to pay $1,000 to someone, you need to go to money changer or bank and buy the currency. Always use buying rate in payments. But when you receive $1,000 from someone, you always have to go and sell it to the money changer. So always use selling rate in receipts. Which one is buying, which one is selling, that's explained by quotes. If it's indirect quote, division, lower buying, higher selling. If it's the direct quote, multiplication, lower selling, higher buying. So you have to apply averaging on the relevant rate. Like in my examples, I only gave you 1 rate. So you applied averaging there. But if 2 rates are given, which rates you will use to average? You see, if it's a payment question, you will always use the buying rate. And if it's a receipt question, you will always use the selling rate. I want you to just copy the approach of options. I will then explain and move towards the question. All this formatting is just to make life easy for you. Like anyone who has been traditionally facing problems in options, I guarantee after this lecture that will be an easy stuff for all of them. So many people say that we can just provide handouts for that so students can learn, but I won't be able to explain properly right from the handouts. So it's better that you see it here, okay? Rakib, the answer would obviously be the same. That's why I'm using a different approach. Varsha, you are right in your approach as well. They both can be done with the same information. Yes, both approach require same information and same answer. Yes, Noman, it will be. Sal, you have to just patiently watch how it's working. Nominal in options, we don't need the future rate. Wrong. Oriam, that's the main thing, when to take a call option, when to take a put option. So obviously I will be explaining it. Okay, now I want you to explain options because that's the main thing. Because if you get a question worth, let's suppose 15 marks, which incorporates 10 marks of computations, so it is likely that forward exchange contract is just going to give you 1 or 2 marks. Futures is just going to give you 2 or 3 marks. The major marks, 5 to 6 marks, would be of options. It is very important that you consider options here. Okay, and I will make it very easy for you. Okay. There are many people who have done futures with basis approach rather than this averaging approach. I just want to tell them that averaging approach is easier. However, if still you are comfortable with the basis approach, you can do that. Answers will be both cases. I'll just gonna be proving that shortly. So forward exchange contract was rate fixation, and the approach was you just need to divide or multiply by the relevant fixed rate. Okay. In futures, the contract was of rate fixation, but standardized amounts. Okay. And there is three-step approach: lock-in rate. I've explained it in detail. The expected receipts payments using lock-in rate, and the number of contracts. Okay. Options. What are options? Options also fix a rate. Options also fix a rate, but the only difference is that options are not a legal obligation. They're just a right. Okay. You can back off from option. You can let them lapse. You cannot do this with forward exchange contract or futures. However, options, the only difference between options and the other techniques is that options also fix rate, but they just give a right, no obligation. You can back off whenever you want. Okay. Now there are two types of options. One is called call option and one is called put option. There are many students worried about, and they keep on asking, and this is the main thing where students lack. There are two types of option: call option and put option. When to use which option? Okay, so I just told you when you are doing payment, to someone. Okay, let's suppose I have to pay £1,000 to someone. I have to go and buy currency from bank or money changer. So buying means call option. So many people learn that in payment we use call option, correct? In payment you need to buy currency. Buying means call option. But whenever it's a receipt case, you are receiving money. Whenever you receive $1,000, you don't buy, you sell. Selling means put option. Okay. Whenever you can learn this, in payments always call option, in receipts always put option, because in payment you have to buy from someone. Buying is calling, and in receipt you have to sell. Selling is put. Okay. So we will discuss it in more detail in the question. Okay. So how do options work? So you just need to learn the format of options. That will make life extremely easy for you. Whenever there is a case of payments, you need to learn the formula. In case of payments, the options work: expected payments plus unhedged amount plus premium payment. Okay. Whereas in receipts, the formula of receipts is expected receipts plus unhedged minus premium payable. Now, what is the difference in payments and receipts? Obviously, whenever you want to enter into option, you have to pay some premium upfront. In options, you can always back off, but in entering options, you always have to pay a premium. So in payments case, when you have to pay the premium, it's increasing your cost. That's why I am increasing it, adding it. In payments, I have to pay the premium. The payment of premium increases my payments, adding. But in receipts, inflow case, when I have to pay the premium reduces my receipts. The premium which I have to pay, it reduces my receipt. That's why I'm deducting. Okay. There was a question from a student why we are adding premium at one place and deducting premium at one place. Easy. In payments, when you pay the premium, it increases your payments. So add it. In receipts, when you pay the premium, it reduces your receipts. So deduct it. Okay. So you can basically learn the format that in receipts or payments, it's expected receipts or payments plus unhedged plus premium payable. Now I want you to pay attention carefully. I'm telling you some golden things. And the first thing you need is expected receipts or expected payments. The first thing you need is expected receipts or expected payments. The formula of expected receipts or expected payments is number of contracts into contract size. The formula of expected receipts or expected payments is number of contracts into contract size. Number of contracts is expected receipts or payments in foreign currency over exercise price divided by contract size. I've made the formulas myself to make life easy for you. Okay, contract size would be given in the question. So number of contracts is expected receipts or payments over exercise price over contract size. Number of contracts into contract size give you expected receipts or payments. I'm telling you for both simultaneously because I don't know whether the question will test receipts or payments. Okay, now let's suppose when you calculate this number of contracts, it comes, let's suppose 101.4 contracts or 101.2 contracts or 101.7 contracts. Obviously, no one is going to give you mathematical contracts 101.4. You can't take 101.4 contracts from a money changer. You can't take 101.2 contracts. You can't take 101.7 contracts. Okay. So if the answer is coming 101.4 or 101.2 or 101.7, you can only get 101 contracts. You can't take decimal contracts. No one gives you decimal contracts in real world. Let's suppose number of contracts are coming 98.3. You can't get 98.3 contracts. You can get 98 contracts. So if you only take whole number contracts 101 or 98, it's likely that whole amount won't be hedged. Some would be left. That is called unhedged. That is called unhedged. Because obviously, if the mathematical answer is coming 98.3 contracts and you're only able to take 98 contracts, some amount would be left. It won't be covered. That is called unhedged. You need to find unhedged as well. The formula you need to learn: expected receipts or payments in foreign currency minus number of contracts into contract side into excess price. Okay. Finally, the third thing you have to compute is premium payable. Obviously, either you take call option or put option, you have to pay premium. Premiums formula is number of contracts into contract size into premium. Okay. You need to learn two important things. The formula of payments is expected payments plus unhedged plus premium. Receipts, its total receipts is expected receipts plus unhedged minus premium. Since premium increases my cost, so in payment I'm adding. Since premium reduces my receipts, I'm deducting. Okay. In payment, you have to buy currency. Buying means call option. And receipts, you have to sell currency. That's put option. Okay. The formula of expected receipts or payments, the first thing is number of contracts into contract size. How do you get number of contracts? I've told you. For unhedged, it's expected receipts or payments minus number of contracts into contract size into excess price. And for premium, it's number of contracts into contract size into premium. What's the concept of unhedged? The contracts may come in decimals. I am telling you one thing: if the contract size comes in whole numbers, 101, 102, 103, no amount would be left unhedged. But since the contracts come in decimals, you can't take whole decimal contracts. You have to take whole contracts. That's why some amount remains. That's unhedged. Okay. Now listen to last thing carefully before going to the question. About premium payable. Whenever you enter into an option, either call or put option, in options you have to pay premium immediately or now. Whenever you enter into an options contract, you have to pay premium immediately. You have to pay premium now immediately. That's why we always use spot rates in premium computation. Spot rates are the today's rates. So you have to pay premium immediately or now. You have to pay premium immediately or now. So when you have to pay premium immediately or now, immediate means today, now. You always use spot rates in premium computation. You have to learn all of this because it carries logic weight as well. Because premium has to be paid now, use spot rates. Okay. Some amount is left as unhedged. Okay. Why unhedged is left? Because in futures and in options, there are standardized contracts. If 101.4 contracts, you only have to take 101. You can't take 101.4 contracts. So some amount unhedged remains. Now, this unhedged amount cannot be hedged by futures because they are standardized contracts. This unhedged amount cannot be hedged by options because options are also standardized contracts. This is always hedged using forward exchange contract technique. because forward exchange contract technique is the only technique which is not standardized contracts. You cannot, as per your own ways, decimals, any number, it's your wish. So unhedged cannot be handled by forward options. Unhedged cannot be hedged by futures. Okay, both are standardized. Unhedged can only be hedged through forward exchange contract. So you will see in a solution, this makes it a mess, that there are many formulas, but premium spot rate because premium is to pay now. Unhedged forward exchange contract because no other technique can hedge that. Okay, any questions? Okay, actually, I only look at questions when I tell you to send questions. So if we will constantly open the questions tab and I will answer at every minute or second, then it won't be possible to teach because there are 50s and 60s of questions. So always when I say questions, you can give questions that time every 15-20 minutes. I obviously tell you to ask questions. So let's start. Naman, whenever the question says to incorporate its unhedged, you have to do that. Okay. Menahel, it's never possible that unhedged is subtracted. Arlene, I will try. Rakib Uzaman, the past paper question we will be dealing, it would have two rates, don't worry. No, Varsha. Charity, I will just explain premium again, wait. Kotlia, it is absolutely not possible to answer that what is the expected content of investment appraisal or expected content of options. Everything is important. You have to cover everything. Jacker, if you take 99 contracts instead of 98.3, you're overhedging. So overhead has to be deducted, but I would advise you, since you're following my approach, use the underhedge. Okay. Rakibuzzaman, if internet problem and voice problem is in my side, all 150 students would be having problems. Since you are the only one having problems, so it's at your side. Okay. Mohammed Yunus, the difference between futures and options is that futures have to be fulfilled, in options you can back off. There is no obligation. Jangobas, you have to complete the lecture to be able to completely get a grip on call and put option. Okay, the basic rule is in call option, you have to, since you are paying, so in payment, you have to buy, you need call option, and receipt, you need put option. What are the exceptions? Please stay tuned. Yes, Abdul Wahab. Agnes, if the question asks, then you have to, else no need. Yes, Clement, if the number of contracts is in whole number, even if you apply my formula, the zero value will come in unhedged, because logically, if the whole number of contracts are taken, there is absolutely no unhedged amounts. Yes, Oriam, for any decimal figure, you need to use the lower value, like 98.8 contracts, take 98, 99.7 contracts, take 99. Okay, so what did I teach you about options? Because that's the main stuff. Just a quick recap. The formula of payments is expected payments plus unhedged plus premium payable. The formula of receipts is expected receipts plus unhedged minus premium payable. Now, what is the difference between all of these? Premium. Obviously, whenever you enter into option, you have to pay premium. Premium increases your cost. So in payments, you add it, but it reduces your receipts. So in receipts, you deduct it. Okay. The formula of expected receipts for payments is number of contracts into contract size. How is number of contracts computed? I've told you, it's in front of you. Premium payable is number of contracts into contract size into premium. And since number of contracts come in decimals, so you can't get decimal contracts, you have to take the lower figure. If you take the higher one, it's overheads. Better avoid that approach. It will still give the same answer, but my advice, take the lower figure. So if it's 101.4 contracts, you take 101 contracts. All amount won't be hedged. Some amount is left as unhedged. The formula of unhedged is expected receipts or payments in foreign currency minus number of contracts into contract size into excise price. Okay. Which option to take? In payment, you have to buy. So take a call option. In receipts, you have to sell. So take put option. Unhedged amount is not handled by for futures or options because they're standardized. So only use forward exchange contract. And in premium, any option you take, premium has to be paid immediately now. So we always use spot rates. Okay, I've told you the formula of futures. I've told you the formula of forward as well. Okay, so let's just take a 10 minutes water or coffee or 3 break, and after 10 minutes we will be starting our past paper question, which will help you clear all the issues. Okay, so if you have any questions, you can still ask. I will go to the break after answering all of the questions. I'm writing break 10 minutes because yesterday when I came back from the break, I just announced the break orally, and there are many of the questions that we can't hear you, we can't see you, what happened to the class. So now it's break 10 minutes, okay? Kotler, thanks for the information, I know that. Varsha, you have to show the working for two options. Asanjawad, there is a tab of handouts in the GoToWebinar tab. You can get the handouts from there. Ishrat, can you repeat your question, please? Ishrat Jahan Sonia. Yes, Ishrat, I will try to brief it. And if it's not possible, you're always welcome on WhatsApp and get an idea about that. Okay, so we are resuming now. Okay, so we will be discussing now a past paper question. On this ACCA practice platform. So I told you yesterday about the initial instructions page. Ready to begin the exam? Yes. Again, section A, section B. This was the question number 1, which we discussed in the last class. Now we are moving towards second question. Okay, so I told you in the last class that the question has some exhibits. The question paper has some exhibits. So you need to click on exhibits to get the things right. Then it has requirements, and then you need to give your response either on word processor or either on spreadsheet. There are a few students asking me that how to make a report. Again, obviously, due to me covering maximum aspects, I wasn't able to show you the complete report. However, the notes I provided you and the format I provided you, it clearly mentions a report. You can refer it. And most welcome, you all of you, if you have any questions, you can refer to me on WhatsApp. Okay, like there are a few students who are asking question on questions tab regarding investment appraisal. So obviously I can't answer investment appraisal today, so but you're most welcome on my group. Okay, so I have clicked on exhibit 1 and we will start in this question. So the question states, Casa Sofia company based in a European country. So Casa Sofia is based in Europe, that uses euro. Constructs and maintains advanced energy efficient commercial properties around the world. So Casa Sofia is based in a European country, it uses euro. Based European country uses euro. That's very important. Where are you based? What is your currency to decide the code? So Casa Sofia based in a European country that uses euro, constructs and maintains advanced energy efficient commercial properties around the world. It has just completed a major project in USA and is due to receive the final payment of US $20 million in 4 months. So Casa Sofia is based in a European country. It uses euro. It constructs and maintains advanced energy efficient commercial properties around the world. It has just completed a major project in USA and is due to receive the final payment of US $20 million in 4 months. So the important thing is, company is planning to receive US $20 million in 4 months. Next, Casa Sofia is planning to commence a major construction and maintenance project in Mazabia, a small African country, in 6 months. The government-owned project is expected to last for 3 years, during which time Casa Sofia will complete the construction of state-of-the-art energy-efficient properties and provide training to a local Mazabian company in maintaining properties. The carbon-neutral status of the building has attracted some grant funding from European Union. and these funds will be provided in Mazabian shillings. Casa Sofia company intends to finance the project using 20 million it is due to receive and borrow the rest through a euro loan. It is intended that US dollar receipts will be converted into euros and invested in short dated bills until they are required. These funds plus the loan will be converted into shillings on the date required at the spot rate at that time. Mazabia's government requires Casa Sofia to deposit shillings 2.64 billion it needs for the project with Mazabia Central Bank at the commencement of the project. In return, Casa Sofia will receive the fixed sum of shilling 1.5 billion after tax at the end of each year for a period of 3 years. Neither of these amounts is subject to inflationary increases. The relevant risk-adjusted discount rate is 12%. Okay. The exhibit has ended, so I need to move towards the next exhibit, which states financial information. Look at the financial information. Exchange rates available to Casa Sofia. The spot rates are given. Now pay attention. The spot rates are US dollar 1.3585 dash US dollar 1.3618 per euro 1. These are US dollar per euro. Okay. So see, the people who are worried, two rates are given. When you are given with 4-month forward rates, it's 4-month forward rate US dollar 1.3588 dash US dollar 1.3623 per euro. So euro is coming in denominator, it's per euro, right? The rates are US dollar per euro. So euro is coming in denominator. It's indirect quote. Divide. Lower rate. Buying. Higher rate. Sell. Agree? Once again, go back to the question. I will write it also later. That you are given with financial information. First, you are given spot rates. US dollar 1.3585 dash US dollar 1.3618 per euro. Per euro means euro in denominator. And 4-month forward is US dollar 1.3588 dash US dollar 1.3623 per euro. And then you are given with MSHS, that's shillings, 116 dash shillings 128 per euro, but 4-month rate is not available. After that, you are giving information about currency futures. The contract size of currency futures is 125,000 euros. I told you futures are of standardized nature. Contract size 125,000 euros. Quotation is dollar per euro. Again, dollar per euro means euro is in denominator in direct quote. So you're given futures for 2-month expiry 1.3633, 5-month expiry 1.3698. Okay. And then you are given information about currency options. The contract size again standardized 125,000 euros. Exercise price quotation is dollar per euro. Again, dollar per euro and cents per euro. Either it's dollar per euro or cents per euro. Euro is per euro denominator. Either it's dollar per euro or cents per euro. Euro is in denominator. Okay. You're given two exercise prices, 1.36, 1.38. You're given calls and puts. 2-month expiry calls, 5-month expiry calls, 2-month expiry puts, 5-month expiry puts, and this figures in the middle in calls and puts. These figures. You need to pay attention to this. All these figures which I have highlighted, this 2.35, 2.8, 2.47, 2.98, 1.88, 2.23, 4.23, 4.64, all these figures which I have highlighted, these are all premiums, because whenever you want to enter into call or put option, you need to pay premium. So this 2.35, 2.8, 2.47, 2.98, all of this is premium. However, you are given call option, puts option, 2 exercise prices are given, 2-month expiry options are given, 5-month expiry options are given. The figures down are the premiums. Okay, I want you to pay attention to this contract size. I want you to pay attention to this contract size. Okay, now I'm going back to exhibit 1. The relevant paragraph of Exhibit 1 is Casa Sofia, based in European country that uses euro, constructs and maintains advanced energy efficient commercial properties around the world. It has just completed a major project in USA and is due to receive final payment of $20 million in 4 months. Company is expecting to receive $20 million in 4 months. Now, when you go to financial information, exchange rates are spot, US dollar 1.3585, that's US dollar 1.3618 per euro. The 4-month forward are US dollar 1.3588, that US dollar 1.3623 per euro. The futures contract size 125,000 euros, dollar per euro, 2-month expiry, 5-month expiry. Options also have contract size. The quotation is dollar per euro or cents per euro, euros in denominator. You are given 2 exercise prices with calls and puts of 2 months and 5 months. Okay, now what's the requirement? See requirement A. Advise Casa Sofia on and recommend an appropriate hedging strategy for the US dollar income it is due to receive in 4 months. My response should be on Word or spreadsheet, is up to me, my choice. If I open the spreadsheet, so advise Casa Sofia on and recommend an appropriate hedging strategy for the US dollar income. What is the US dollar income it is due to receive in 4 months? Company expects to receive US dollar 20 million in 4 months. So the question asks, advise Casa Sofia and recommend an appropriate hedging strategy for the US dollar income it is due to receive in 4 months. What is the US dollar income it is due to receive in 4 months? It's 20 million US dollar as per paragraph 1. You can verify. Casa Sofia, based in a European country that uses euro, constructs and maintains advanced energy efficient commercial properties around the world, has just completed a major project in USA and is due to receive final payment of $20 million in 4 months. So that's what the question asks. Advise Casa Sofia and recommend an appropriate hedging strategy for the US dollar income it is due to receive in 4 months. So you need to advise Casa Sofia and recommend an appropriate hedging strategy for the US dollar income it is due to receive in 4 months. So I am about to advise on a recommend appropriate hedging strategy for the US dollar income it is due to receive in 4 months. Now, the interesting portion is this US dollar income it is due to receive in 4 months, $20 million. You need to advise and recommend an appropriate hedging strategy. The question won't ask you the name of the hedging strategy. You have to decide which hedging strategies to use. So commonly you should use futures, options and forward. Okay, so when it asks to recommend an appropriate hedging strategy, the question didn't ask you to apply this strategy, just ask apply an appropriate hedging strategy. You have to decide appropriate hedging strategy, and ideally the appropriate strategy should be futures, options and forwards. Okay, now company expects to receive $20 million in 4 months. The company expects to receive $20 million in 4 months. Casa Sofia, where it is based? In Europe. Casa Sofia, where it is based? In Europe. Okay. Euro is the currency. It is receiving $20 million in 4 months. Is there any risk? Yes. Company is expecting to receive US dollar 20 million in 4 months. What is the risk? The rates meeting. It needs to hedge it. So you need to recommend an appropriate hedging strategy, and ideally the strategy should be forwards, futures, options. Let's start. The strategy number 1 I'm applying: forward exchange contract. Now pay attention, how do we answer all of this stuff? Okay, forward exchange contract. Okay. When you are doing forward exchange contract, and you are doing forward exchange contract technique, will you use data of futures? Will you use data of options? Or will you use data of forwards? Tell me. The one I have highlighted in green. Okay. When you are doing forward exchange contract, you won't use the data of futures. Why? Future will be using futures. You won't use the data of options. It will be used in options. In forward exchange contract technique, you will use data of forwards. Am I right? Yes, in forward exchange contract, we have to use data of forwards. We won't use data of futures or options. We will use data of forwards. Okay, so there are two rates, 1.3588, 1.3623. So which is the quote? Its company is based in Europe, and euro is coming in per euro denominator. It's an indirect quote, you need to divide. And the lower rate is the buying rate and the higher rate is the selling rate. So what is the buying rate? The lower one, 1.3588. And what is the selling rate? The higher one, 1.3623. So which rate to select? You have to divide, because it's an indirect quote. An indirect quote, lower is the buying one, higher is the selling one. So which rate you should take? Now it's a receipt case or a payment case? It's a receipt case. You are receiving money. So you won't buy, you will sell. Whenever we receive money, we go to money changer and sell. So we will use the selling rate, which is higher, 1.3623. You just have to do this. US dollar, $20 million divided by 1.3623. Euro, 14.68 million. I could have just directly done it via Excel formulas, but I just wanted to show you the complete working. The first technique, forward exchange contract. Obviously, the question didn't ask for any technique. You have to decide. When the question asks, recommend a suitable hedging strategy for the US dollar income 20 billion it is due to receive in 4 months, you have to recommend an appropriate strategy, and the appropriate strategy you should show is forwards, futures, and options. Let's start with forward exchange contract. You are receiving 20 million. You know the approach, either divide or multiply with the relevant fixed rate. In forward exchange contract, you won't use the data of futures. You won't use the data of options. Instead, you should use the data of forwards. To use the data of forwards, it was per euro, it was an indirect quote, so divide. Lower buying, higher selling. In payments, you have to buy, so use buying rate. In receipts, you have to sell, so use the selling rate. You got 14.68 million euros. Okay, If we have any questions, I can take them for you. And then I will move towards the second technique, that is currency futures. Mohammed, it's not possible that forwards is not given. Rounding off is not a problem, don't worry. Ahmad Junaid, you have to copy paste from there, okay, from the question. Upasna, it can be marked by a tutor. So Shalika, we can repeat forward exchange contract. Forward exchange contract approach is just one single step. Multiply or divide with the relevant fixed rate. So you are receiving $20 million, multiply or divide. It's an indirect quote you need to divide, and it's receipt you need to sell. So take the selling rate, which an indirect quote is higher. Had it been a payment case, I would have taken the buying rate. Okay. Salima, the advisable options are futures, options, and forwards. Jakir, you have to wait that which is the best one. I will just tell you. Rakib Zaman, I have told you again and again that even if you have two rates for future, if it's indirect quote, lower is buying, higher is selling. So in receipt case, you have to take the selling one, and in payment case, you have to take the buying ones. It's not a problem at all. I don't know why you are so much worried about it. Believe me, it's nothing like that. Even if you are provided two rates in futures, if it's a payment case, you just need the buying rate, ignore the selling rate. And if it's a receipt case, just the selling rate. Noman, it's up to you. You can type or copy paste. Okay. Now let's do currency futures. I have told you in currency futures, you have to perform 3 steps. The first step is lock-in rate. Step 2, expected receipts or payments. This is the receipts question. Watch carefully, then copy. Let's start. The main thing is lock-in rate. So when do you plan to receive the amount? In 4 months? You plan to receive the amount in 4 months. Go back to the question. To solve futures, which data will you use? Futures, options, or forwards? Obviously futures. Now you will use the data of futures. There is absolutely no need to look at any other data because I am doing it for futures. So the only relevant data is my futures one. This green tab. Why should I look at forwards? Why should I look at options? Only futures. Okay. So let's compute lock-in rate. So you were given rates of 2-month expiry and you were given rate of 5-month expiry, right? If you look at the question, you are given rates of 2-month expiry and you are given rates of 5-month expiry. Okay, 1.3633 and 1.3698. Is that the case? Yes. You're given 2-month expiry 1.3633 and 5-month expiry 1.3698. Okay. You need a 4-month rate because the payment is coming in 4 months. You need a 4-month rate. So you need to find the lock-in rate. Okay. What is the trend? It's 1.3633 minus 1.3698. It's increasing by 0.0065 in 3 months, right? It's increasing by 0.0065. You need to take the difference in 3 months. Okay, so if it's increasing by 0.0065 in 3 months, per month is 0.0065 over 3 months equals 0.002166, right? Okay, so now it's rising by 0.001266 per month. So what you can do is you need a 4-month rate. So you have the 2-month rate 1.3633, the 4-month rate, plus it's rising by 0.002166 per month. If you add one time, it increases to 3 months, plus 0.002166 one more time. Okay, so it equals, or you can multiply it with 2, it's up to you. It's 1.36. This is the lock-in rate. Okay. Okay, because you were given 2-month expiry, 5-month expiry, so you took a rising trend on 3 months, you took per month, and you took the 2-month rate, added 2 months, so it gets 4-month rate. Okay, now expected receipts using lock-in rate. What is the receipt? It's USD 20 million. You need to find the expected receipts using this lock-in rate. So what is the receipt? US dollar 20 million. Multiply, divide. Again, it was per euro indirect quote. You need to divide by this lock-in rate. 1.3676 is the lock-in rate. Okay, so you get euro 14.624 million. Okay, so this is the expected receipt using this lock-in rate. And finally, you need to enter number of contracts. Okay, so what is the receipt? It's 14.624 million. Okay, 14.624 million is the receipt. And if you check the contract size is 125,000 euros, that means in millions it's 0.125. You're doing in millions, it's 0.125 million, the contract size. So 14.624 million euros is the receipt divided by contract size. It's euro 0.125 million. You get number of contracts. 117 contracts. So these were the 3 steps I wanted to show you for futures. That at first the lock-in rate. I hope you get the lock-in rate and receipts or payments using this lock-in rate. If it's direct quote, multiply, and direct quote, divide, and then number of contracts. Okay, you can copy this stuff. If you have any questions, you can ask, then we will move towards options, the main thing. Elmer, we will try. Amdi Fazlul, you can use that approach, no problem. No, for us, we can't use 2 methods because we need to complete the question. If you want basis method, you can do it from the book or kit. Jankopas, why are you using the spot rate? It's not given in futures data. In futures data, spot rate is not given. Had it been given, then we could have done that. Sufyan, if the question states, then else no need. Onam, it's not possible. Noman, time management is in your control. You have to decide which headings to give and which not. I can't guide headings, but obviously you need to work smartly. In options, we will round down because we have to deal with underhedged. Here, we don't need to do underhedged. Oriam, because the question didn't ask us for gain or loss on futures. Shilpa, it carries max. Yes, Sufyan, it's 14.724 million. 14.624 million, sorry. Yes, Evelyn, you're right. Number of contracts is very easy. It's 14.624 million euros. The receipts is coming, and the contract size is 0.125 million euros. So you need to divide them to get the contracts. FNWA, I explained direct and indirect quote in detail yesterday, so it is advisable you see the yesterday session. Princess Donicher, we are finding number of contracts. So you have to divide with contract size. Why would you divide with other price? Winston Hens, since there is no over under hedging being done in futures, it doesn't matter in futures you take upside or downside, but in options, since it's under hedge, I would advise you to take down value. What you have to write, Shilpa, it's better you should refer to my answer. Evelyn, the amount we will receive after 4 months through this commitment is in step 2, 14.624 million euros. Vishal, it's not possible unless you're applying it wrongly. Okay, now the main thing. Anuman, what you have to write, you should read my answer provided. I'm doing options here because it involves some important, too much calculations, and we aren't left with much time to write all the calculations on a spreadsheet. Okay, now stop typing questions because you will lose some important stuff. Better focus on technique number 3, options. Okay. Okay. When you're starting options, listen carefully. This is one of the golden things you will learn from my session. When you start options, first write what is the formula of options. Expected receipts plus unhedged amount, okay, minus premium payable. Expected receipts plus unhedged amount minus premium payable. You have to get three things right. Expected receipts, number one. Unhedged, number two. And premium, number three. If you get these three things right, you just have to add less and the options answer will come. Okay. Now, you are about to solve options. So for options, you will use the data of options. For options, you will use the data of options. It's 20 million receipt in 4 months, and you need to use the data of options. Now, firstly, there are two exercise prices given, 1.36, 1.38. 1.36, 1.38. Okay, you have to work on both exercise prices. It carries marks. If more than two are given, you can work any two of your choice. But if two are given, you have to work on both. I will be doing the first exercise price. If exercise price is 1.36, okay, I will be doing the first exercise price. It's 1.36, okay. Just get the concept. Second exercise price has to be done by you yourself, okay. So now remember one thing carefully. Remember one thing carefully. I'm doing the first exercise price, okay? Leave the others. When doing options, you will only look at the data of options, the highlighted one. You don't need to see forwards. You don't need to see futures. You will only look at options. Okay. So it's options, contract size euro 125,000, exercise prices dollar per euro, cents per euro. It's an indirect. Okay. You're given two options, calls and puts, 2-month expiry, 5-month expiry, 2-month expiry, 5-month expiry, and the exercise price are given. I'm using the first exercise price. Understand it carefully. Second exercise price has to be taken care of you by yourself. Okay. Now, the first thing. There are 4 columns of options, 2 months expiry, 5 months expiry, 2 columns for calls, and 2-month expiry, 5-month expiry, 2 columns for put. Okay. One thing, you are receiving money after 4 months. You are receiving money after 4 months. Okay. So obviously 2-month expiry is irrelevant for you because 2 months would have passed and then you will be receiving money. Okay. So 2-month expiry is totally irrelevant for you. The only relevant is 5-month expiry. There is no concept of averaging or locking in like futures and options. No. There are 2 options given, calls and puts with 2-month expiry, 5-month expiry. Since you're receiving after 4 months, 2 months would have already passed, just cancel them. Only 5-month expiry is relevant. Only 5-month expiry is relevant. Okay. So see, it's a good thing. 2 columns have been eliminated. The 2-month expiry calls, the 2-month expiry puts have been eliminated. Okay. Now, first thing, the 2 columns are cancelled. Out of these 4 columns, only 1 is relevant. Okay. So I have to eliminate 3. 2 have been eliminated because you are receiving after 4 months. 2-month expiry will have passed. It's irrelevant. Take 5-month expiry. 5-month expiry calls or 5 months expiry puts. People who wrote learn. I'm talking to them. It's a 5-minute lecture and you have to be crystal clear in that. People who wrote learn. Oh, it's a receipt case. Our tutor taught in the class that in receipts we have to sell, take put option. Receipts we have to sell, take put option. They will take put option and do the work. This is not how it works. You can't rote learn. It is a valid principle that in receipts you need to sell, so take put option. In payments you need to buy, take call option. But this is not how it works by rote learning. You have to understand the concept. Listen carefully. You are receiving US dollar 20 million. You are in Europe, right? You are in Europe, right? Look at my hands. You are in Europe, right? you are receiving US dollar 20 million. So if you are receiving US dollar 20 million, what will you do? You will go to money changer and sell dollars. You have to sell dollars. Take put option, selling, take put option, sell dollars. But when you go to the money changer, you see that in options, the contract size is not offered in dollars. Here in this question, the contract size is offered in euros. The money changer or the financial institution is not giving option size in dollars. He's giving option size in euros. So you are receiving US dollar 20 million. You need to sell dollars. Take sell, put option for dollars. But he's not offering contract of option in dollars. He's offering in euros. You don't need to go out of the shop or the money changer shop or the bank. Sorry, we are in the wrong place. No, you should use your mind. You're in Europe, right? You're receiving US dollar 20 million. If you're receiving 20 million USD, you need to sell 20 million USD. Take, sell dollars, put option for dollars. But selling dollars means in Europe, if you're selling dollars, what are you taking? Euros in against. Buying euros, selling dollars, but buying euros. Since he is giving contract size in euros, you are not selling euros, you are taking, buying euros. You will use call option in receipts. So 5-month call option is the relevant rate, and 5-month call option at 1.36 means your relevant figure is 2.8. Repeat. I'm in Pakistan, okay? I'm receiving 100,000 GBP. If I'm in Pakistan, I'm receiving 100,000 GBP. What do I need to do? I need to sell GBP. Sell GBP means take put option for GBP. If I go to the money changer in offering contract in GBP, I have to sell GBP. Sell means take put option of GBP. But if he's offering contract in PKR, I should not go out of the shop that I'm at the wrong place. I should use my mind that I'm in Pakistan. I'm receiving 100,000 GBP. I need to sell GBP. Means I need to use put option for GBP. But selling GBP means taking PKR. I'm taking, buying PKR. If the contract is offered in PKR, take call option. I'm taking PKR, not selling PKR. Go in payments. You should not rote learn that in payments always buy call option. You need to understand it carefully. Let's suppose I'm in Pakistan. I have to pay 100,000 USD. Let's suppose I'm in Pakistan. I have to pay 100,000 USD. So if I have to pay 100,000 USD, I have to buy. If I have to pay 100,000 USD, I have to buy. Buy means call option. So I will go to money changer and tell him I have to pay $100,000. I need to buy. Take call option in buying, in payment. But let's suppose he's not offering contract in dollars. He's offering in PKR. I need to make payment of $100,000, buy $100,000. Take call option. But if the contract is in dollars, then I have to buy. If the contract is being offered in PKR, I'm buying dollars. What is buying dollars? Giving, selling PKR. Buying dollars means I have to give PKR, sell PKR. If the contract is in PKR, I have to sell PKR, take put, even in payment. But if the contract is in dollars, I have to buy dollars, take call option. I'm repeating again. It's a very important concept. I am in Europe at the moment in this question. Okay. And I'm receiving $20 million. So your principle is correct. If you're receiving $20 million, you need to sell it. Take put, right to sell. But you are selling dollars. The contract is not in dollars. The contract is in euros. See in the question, the options contract is in euros. You're selling dollars. You have to sell dollars, but take euros, buy euros. So since it's in euros, you are not selling euros, you're buying, take put option. So put option, sorry, call option in 5 months, it's 2.8. I am in Europe one final time. I am in Europe. I'm receiving $20 million. So if I'm receiving $20 million, I have to sell euros, take put option. If I am in Europe, I'm receiving $20 million. I have to sell dollars. Receiving dollars, I will sell. Take put option for dollars. But if the contract size is given in dollars, then we can do that. That I'm receiving $20 million, I have to sell dollars. Take put option for dollars. The contract size is in euros. So selling dollars means I'm taking euros in against, buying euros. Take call option because you're buying euros. Call option buying means call. 5 month call option, you have already canceled 2 months. So at 1.36 price, 2.8 is the relevant premium. Okay. I can take the questions regarding this, then I will complete options because that was the main thing. The calculation is easy. Sunburn because company doesn't have any option. Yes, Preet, call option. Shalika, if the contract is being offered in dollars, I'm receiving dollars, I have to sell dollars. Selling means take put option for dollars. But here the contract is in euros. So selling dollars means taking euros. So since the contract is in euros, I have to take call. Noman, you don't have to decide exercise price. You have to work on both exercise price. Same question, Jakir. You have to work on both exercise price. First, you have to work on 1.36, which I'm doing, and then you have to take 1.3. Time it up, I will repeat it. Don't worry. The people were asking which exercise price we should take. You are given with two exercise prices. I've told you, you have to work on both exercise price. Firstly, you have to do on 1.36, then you have to do on 1.38. Yes, Salaima, you can learn this also. I don't advise rote learning, but you can learn this also. That if the contract is offered in same currency, we use traditional rule. Selling put, buying call. But if the offering currency is in different currency, then the rules change. Perfect. You can get this. So I am repeating it again on request of few students. Okay, so we are doing options again. Firstly, on the notepad, I have to solve options. So I told you that in receipts case, the options formula is expected receipts plus unhedged minus premium payable. And you need three things: expected receipts, the unhedged, and the premium. There are two exercise prices given in the question. It's 1.36 and 1.38. I have to work on both. I am doing the first exercise price, that is 1.36. Now, in front of 1.36 price, there are two call options given of 2-month expiry, 5-month expiry, and two put options given of 2-month expiry or 5-month expiry. Okay, only one is relevant. Which one to opt? I told you that since you are receiving in 4 months, the 2-month period would have passed. You need to ignore them. You will take, it's your no choice. You have no choice. 2-month expiry would have passed because you're receiving in 4 months. Always take the later one. 5-month expiry calls and 5-month expiry puts are relevant. But which 5-month is relevant, calls or puts? Traditional rule. Since it's a receipt case. So if you are receiving dollars, it's a receipt case, you are receiving $20 million, obviously we'll go and sell $20 million. Sell means put option. When you go to the money changer, the contract size is not offered in dollars, it's offered in euros. You are receiving $20 million, you need to sell $20 million. Sell means take put option for dollars, but the contract size is not in dollars. Had it been $125,000, what would I have done? I am receiving $20 million. The contract is also in dollars. I need to sell dollars. He's offering the contract in dollars. I need to sell dollars, take put option. But the contract is being offered in euros. I am receiving $20 million. I need to sell dollars. Take put option for dollars, but the contract is not being offered in dollars. So selling dollars means taking euros, buying euros. Selling dollars means taking euros. You won't just sell $20 million and go empty handed. No, selling dollars means you are taking euros. So you are taking euros. If the contract is in dollars, you need to sell dollars, take put option.
But if the contract says it's in euros, you are not selling euros, you are taking euros. Take call option. So in receipt, we are taking call option, even though I taught you that in receipt, we need to sell take put option. But you need to look at the scenario. If you are receiving $20 million, you need to sell $20 million, take put option. The contract is in dollars, then put. If it's in other currency, your call. If you have to pay $20 million, you have to buy $20 million, take call option for dollars. If the contract is in dollars, take call option, you need to buy dollars. But if the contract is in euros, buying dollars means giving something, selling euros. If it's in euros, take put option. Here it's a receipt case. One last thing, if I'm receiving something $20 million, I need to sell dollars, I need to take put option for dollars. But the contract is not in dollars, it's in euros. Selling dollars means I'm taking euros. I'm being offered in euros, so I'm taking euros, call option. 5-month call option is relevant, and at 1.36, it's 2.8. Okay, now let's start the working and finish it. The first thing we have to do is to find expected receipts. Now, how do you find expected receipts? Remember, it's number of contracts into contract size. Number of contracts. I've told you the working of number of contracts. Number of contracts is expected receipts or payments divided by exercise price. What is the exercise price I'm using? 1.36 over contract size. It's 0.125 million. It's 125,000. So 0.125 million. So it's 117.64 contract. So obviously I can't take 117.64. I will take downside 117 contracts. So number of contracts are 117 into contract size is 0.125 million euros. This comes to 14.625 million euros. Okay, number of contracts, it's the formula, expected receipts over exercise price divided by contract size, 117.64. So I took how much? 117, took the downside one. So number of contracts is 117 into contract size, it's 0.125 million euros, 14.625. Okay, unhedged. You know the formula of unhedged. You know the formula of unhedged. Expected receipts in foreign currency, 20 million minus number of contracts into contract size. Into exercise price. Okay, expected receipts in foreign currency was 20 million, but you only hedged 117 contracts at 0.125 million at 1.36. Only hedged 19.89 million. So what is the unhedged? 0.11 million. That's unhedged. Because you took less contracts, so 0.11 million remains unhedged. Okay. I told you this 0.11 million unhedged will be dealt through forward exchange contract. Okay. How much you are receiving unhedged? $0.11 million. How much you are receiving unhedged? $0.11 million. This will be hedged using forward exchange contract. How much you are receiving in unhedged? $0.11 million. This will be hedged using forward exchange contract. Okay, go back to the question. Since this will be hedged using forward exchange contract, you should not use futures or options. You should use forward. Right?
Since you are going to hedge this through forward exchange contract, only use the forward rate. It's an indirect quote, so you need to divide. Lower buying, higher selling. 1.358 is lower buying, higher selling. So 0.11 million is the receipt unhedged. Hedge it through forward exchange contract. So divide. Receipt means selling 1.3623. This makes it euro. $0.08 million. Okay, because this has to be hedged through forward exchange contract, the unhedged amount. No other technique hedges it. Okay, and finally the premium payable. Okay, the formula of premium payable is number of contracts into contract size into premium. So number of contracts is 117. Listen this thing carefully because this will end it. Number of contracts 117 to contract size 0.125 million into premium amount. What is the premium? I told you that these middle values mentioned 2.35, 2.8, 2.47, these are the premiums. Okay, so 2.8 is the relevant premium because in my calculation every column was irrelevant except the 5-month call. So 2.8 is the premium, but since the heading states it's in cents, since the heading states is in cents, so I should write it as 0.028. The premium is 2.8, but it's written it's in cents, so I should write it 0.028. The premium comes to 0.4095 million. Now this premium has to be paid now. Okay, so since this premium has to be paid now, use spot rate. Use spot rate. This premium has to be paid now, I told you before, so you need to use spot rate. Okay, how much is the premium? $0.4095 million. Use spot rate. Go back to the question, use spot rate. What the spot rate? It's per euro. Euro is again in denominator, indirect quote, divide it. Okay, so I need to pay the premium. There are two spot rates, indirect quote, lower buying, higher selling. I need to pay premium. I won't receive the premium, I need to pay premium. So if you need to pay premium, in payment you use buying rate or selling rate. In payment you use buying rate. So use the buying rate which is lower, 1.3585. 0.301 million. Okay, so the final answer is expected receipts 14.625 million euros plus unhedged 0.08 million minus premium 0.301 million. Okay, the final answer will be 14.404 million. Okay, now people ask which is the best one. We have done all three, which is the best one. Okay, now listen carefully. We have done three techniques: forwards, futures, options. Options is incomplete. You have to try the second exercise price also. It's 1.38 exercise price. You have to do the workings on your own on 1.38 as well. But let me just conclude that which is the best hedging technique. Now options is giving answer 14.404 million. Okay, futures gave us answer 14.624 million. And forward gave us answer 14.68 million. Recommend which is the best one. In receipts, we select the best, which gives the highest one. Whereas in payment, the best one is one which is giving the lowest answer. Okay, I am telling you options is not complete yet. You haven't get full marks. 1.38 exercise price you have to work and then decide which is the best one. However, in receipts, the best one is the one which is giving highest answer among all. And in payments, the best one is the one which is giving the lowest answer. I am telling you these formulas are very easy for expected receipts, for unhedged, for premium. The only important thing whether to take call or put. In receipts, remember you have to sell, so put. In payments, you have to buy, call. However, look at the contracting currency. If you're receiving dollars, you need to sell dollars. Take put option for dollars. But if the contract size is in dollars, then only put. You need to sell dollars. If the contract size is in euros, selling dollars means taking euros. For euros, I'm taking take call option. Okay, I can take the questions and you can copy the stuff. Yes, Sufyan, you can do that. Osiper Lavani, that's what happens when you sell currency. You are buying something as well. Like I'm in Pakistan, if I sell dollars, I will take PKR, buy PKR. If I buy dollars, I have to sell PKR. So selling one thing means buying other thing. Sandon, we don't require profit and loss working. Yes, Adireto, you are all right. You are perfectly right. 0.125 million is the contract size because the contract size is 125,000 euros. So since I've done every working in millions, I took it in millions. Yes, Priti. Sandon, it's the USD amount because you multiply the contracts with the contract size and the premium. So premium was given in cents and dollars. That's why if you multiply it with dollars, it will become dollars. Ahmad Junaid, because premium has to be paid. If you are paying, you need a buying rate. You will buy. Elmir, again, the premium is in dollars because you multiplied it at 0.0208 and you can see the heading, it's cents, it's dollars. It's no use, Jacker, we just have to earn marks, that's why. Yes, Danish, it's available. Yes, Minal, you are right. Yes, Sudha, you have to show the workings. Minal, I told you we have to show two strike price workings, two exercise price workings. So it's up to you, you select the nearest one or not. So since we have to pay premium, Princess on a chair, since we have to pay premium, so premium has to be paid. Payment decreases our receipt, that's why I'm deducting. However, premium has to be paid. It increases my cost, so in payment I add it. No, Evelyn, you can see I multiplied it with 2.8, 0.0208. As per the question, it was in cents, so it became in dollars. Onam, you can use any method, basis or lock-in one. Yes, Faraz, you should take a lower end contract. Menahel, I use 1.3585 because premium has to be paid, and payment means we have to buy. That's why buying rate. Now, Muhammad Yunus, I am constantly solving everything on spreadsheet. Since we had to complete this question right within the available time, Excel would have taken time. I hope so. You have got a complete crystal idea on how you need to present things on spreadsheet in the last two questions. So I would advise you, you should solve this on spreadsheet yourself. Alan Frederick, for the marking scheme, you should better go to the ACCA website and see the marking scheme. It carries 4 to 5 marks. Now, just to make sure that options is under grip, I had to work on other one, the exercise price 1.38, because I have to solve two exercise prices. So if the exercise price is 1.38, you can go to the question and see. If the exercise price is 1.38, I have cancelled the 2-month premiums and I have decided to take call option. So here the premium is 2.23. Now, if you need to find expected receipts, it's number of contracts into contract size, number of contracts is 20 million over 1.38 now, divided by contract size 0.125 million. So the number of contracts come to 115.94 contracts. So I will take 115 contracts. Into contract size 0.125 million. 14.375 million euros. Okay. Then unhedged expected receipts were 20 million, but I was only able to take 115 contracts at an exercise price of 1.38 and a contract size of 0.125 million. Okay. So out of 20 million, I was only able to hedge 19.8375 million. So unhedged remains 0.1625 million. Okay, this unhedged has to be hedged through forward. So 0.1625 million is the receipt. We will use forward rate, indirect quote divide, and the forward rate was 1.3623. The 4-month forward rate, 0.119 million euros. Okay, and finally the premium. So it's number of contracts into contract size into premium. It's 2.23 means in cents 0.0223. So it becomes 0.32 million. Okay. Premium has to be paid now. So 0.32 million has to be paid now. Use spot buying rate because payment requires buying rate 1.3585. It's 0.236 million euros. So the final answer will be euro 14.375 million for expected receipts plus unhedged 0.119 minus premium 0.236. Okay, so I hope the approach is clear to you. Again, the risk management basically means getting the correct option. So I have told you that calls and puts have to be selected. Again, if I'm receiving in dollars, I have to sell dollars, take put for dollars, but if the other currency is given, then take call. Preeta, you're welcome. Highly appreciated. Okay, so the time is up for today. Feedback for today's session. I need your comments and then I will end the class. Thank you everyone for your wonderful comments. Puzzle overheads will be done if you take it on the higher side. If you take it on the higher side, obviously, then you will overhedge. Instead of 1.5.94, if you take 116 contracts, that means you're overhedging. And then you need to change the sign in the formula. So better use the underhedge technique. Now for us, this is wrong that always forward is the cheapest. This is wrong. You can do many past paper questions in which futures is giving the better answer.